Private credit stress is no longer theoretical, it's happening in real time, but the real question isn't whether stress exists. It's whether this is a contained pressure test or the early signal of something that could ripple into the broader banking system. Over the past few weeks, several major private credit managers, including Apollo Global Management, Ars Management, Morgan Stanley, BlackRock, Blackstone, Blue Owl Capital, and Barings have placed limits on investor withdrawals. That immediately raises alarms, but it's important to separate signal from noise. A redemption cap is not the same as a bank run, and it does not automatically imply insolvency. What it does indicate is friction, investors wanting liquidity at a time when underlying assets are harder to sell or accurately price. Private credit, by definition, operates outside traditional bank lending and public bond markets. It expanded rapidly during years of low interest rates, cheap refinancing, and strong investor confidence. Now that rates are higher and refinancing conditions are tighter, the system is being tested in a way it hasn't been in over a decade. The pressure is especially visible in sectors that were heavily financed during the low-rate era, particularly software and growth-oriented companies where valuations were based more on future expectations than current cash flow. As borrowing costs rise and growth slows, lenders are reassessing risk, and that's feeding directly into investor behavior. Withdrawal requests matter because they force funds to either raise liquidity or restrict access, and neither option is neutral. Still, these developments alone do not confirm a systemic crisis. The connection to banks is real, though. According to analysis from the Federal Reserve Bank of Boston, much of the growth in private credit has been supported by bank-originated financing and liquidity backstops. Banks provide credit lines and funding channels, meaning stress in private credit could, in theory, feed back into the banking system. But context matters. A separate note from the Federal Reserve System has indicated that, so far, the broader financial stability impact appears limited. Even Jerome Powell has stated that regulators are monitoring the sector but do not currently view it as a system-wide threat. Another area often misunderstood is derivatives exposure. Headlines frequently cite the massive notional value of derivatives held by large banks, but notional exposure is not the same as actual risk or loss. These figures can be misleading without understanding netting, hedging, and counterparty structures. Similarly, concerns about deposits often become exaggerated. Current guidance from institutions like the Federal Deposit Insurance Corporation confirms that insured deposits remain protected even in the event of a bank failure. After the regional banking stress seen during the 2023 U.S. bank failures, mechanisms were put in place to recover losses through assessments on banks, not by directly seizing insured depositor funds. So while fear narratives circulate quickly, the structural safeguards still matter. What investors and observers should focus on now is not speculation, but measurable stress indicators. Watch for increasing redemption pressure across funds, rising default rates in private credit portfolios, tightening bank liquidity conditions, and widening gaps between reported valuations and actual transaction prices. Pay close attention to concentrated areas of weakness, especially sectors that relied heavily on cheap debt, and importantly, monitor the tone and actions of regulators such as the Federal Reserve, the Office of the Comptroller of the Currency, and the FDIC. If their stance shifts from monitoring to intervening, that's when the risk profile changes meaningfully. The core takeaway is straightforward. Private credit could act as a fuse, but a fuse alone is not an explosion. The stress we're seeing is real, the interconnections are real, and the valuation challenges are real. What is not confirmed is a cascading banking collapse, widespread depositor losses, or an inevitable financial crisis. Staying informed matters more than reacting emotionally. Maintain sufficient liquidity, understand where your money is held, evaluate counterparty exposure, and recognize the difference between early warning signs and confirmed systemic breakdown.